We're going to get started with the follow-through day. This is critical. I'm sure everybody already knows the follow-through day kind of inside and out, but we do it a little bit differently and want to make sure you guys are on board with how we're going to do it. This is on page 6. So the concept of the follow-through day is really something that Bill came up with decades ago, and the concept was, how do you get in the market? How do you get started? Because that's really critical. Especially if you're in a severe bear market, you're going to try getting in a few times, but you're going to get kicked back out of the market. So he was studying this back in the 60s and came up with the concept of waiting for the market to follow through. And what does that mean? It means you have a rally attempt, which would be right here, an up day, but then you wait for further confirmation, like a day over here. But you don't want to sit through this pain here. So the concept was, let's have a rally day, make sure that it holds, and make sure that you have another day that comes on that shows that power. Let's walk through how we would do it. You're in a downtrend, you're out of the market, and you wait for one up day or a pink day, which we'll talk about in a second, that closes mid-range. But for now, an up day. And then you're going to wait for the fourth day after that to see if you get a follow-on effect where a big up day in increasing volume. Your stop is going to be right underneath the low that was set. So right here, that's your low, and that's when you know if it's going to hold or not. So right here, once it pierces the low of your rally, then you're going to start looking for another rally. That rally has failed. So we go forward a little bit, and it's coming lower, you're out of the market, and you have this day that looks powerful because it has a big spread, it's closing in the upper half, and that we're going to treat as a rally day, and we call that a pink rally day because it's down for the day. Within market school, for it to be a pink rally day, it just has to close in the upper half. If you were to have a conversation with Bill, he would look at it, and he's pickier. He likes to see a big spread like this and actually close 80% closing range or higher. But we've been around Bill enough to know that there's times when he'll change things midstream. So with market school, we had to always have rules in there to make sure that we don't miss a rally, because we know that Bill is very, very flexible in the battlefield, but we had to put kind of a black box together that we could follow. So we're a little bit looser with some of our rules than he might be in certain cases. And the reason being is we know that he can be flexible, and the key is to not miss a rally. And we'd rather get into some rallies that don't work than miss a big rally. For market school, it's just a down day that closes mid-range or higher. It doesn't matter the spread. This one he would consider a pink rally day as well. So that's going to be day 1. So day 1, 2, 3. So on this day, the fourth day or after, we're going to start looking for that follow-through day. So we want a follow-on effect of additional power to know that this low is holding. The key is that this is not penetrated at all. So that's the first thing that's happening. We go day 1, 2, 3, 4, 5, 6 day. We have this powerful feeling. It's up a lot. So that's where we're going to get started in the market. So this is knowledge you guys should already have at this point. Let's go through some specifics on page 5. So the volume requirement, it doesn't have to be above average. It just has to be above the prior day. That's key because sometimes you'll get a follow-through that happens during a holiday time frame where you have light volume in the market. So it's important to know it doesn't have to be above average, just higher than the prior day. Next, this is where it gets a little tricky. The percent requirement is based on volatility. For years and years, Bill had it at 1% until about 99, 2000. Then he started changing it, and he came up with 1.3, 1.5, 0.2. He was all over the place, but what he was sensing is the market was volatile, and so the 1% was not a big enough move. So for a while, we went to 1.25 with this system, and the volatility kind of subsided over the last couple of years. So this is what we came up with after doing a ton of research going back. There's really 4 different times of volatility. Ultra low, we haven't seen ultra low or low volatility for decades. But if you were doing any historical work, that's where you'd want to look at these requirements. The way we measure volatility is we look at the last 200 days and look at the up days, and we get an average. So if the market is really, really ultra low, we can go as low as 0.7. Right now, we're in normal volatility. So we're looking at 1%. Over the last decade, most of the time has been spent between these two. So we've been at normal volatility for a year or so. In cases like 99, 2000, 2002, you're going to be at really essentially 1.25. All right, so let's walk through an example. This is on page 7. This is the time frame we're looking at over here. We're out of the market. We're looking for a rally day. So over here we get a rally day, but we don't get a follow through. This is day 1, 2, 3, 4, 5, 6, and then you undercut. So we're going to start looking again. So we find a rally day. Here's day 1, day 2, day 3. That's undercuts just slightly. You can see because we have the price marked at the peaks and the troughs. So this one just undercut that a little bit. So that becomes our day 1. Day 1, day 2, day 3, day 4. So we get a gap up. And most of the time this 1%, 1.25 doesn't come into play. This is 2.97. It's a really big day. And you can see that the volume is higher than the prior day. So that's our follow-through day. Now to come up with the percentage that we should use, Charles, Justin, and I ended up going through every market bottom that there was, the big ones and the small ones, and marked up a bunch of additional follow-through days to kind of see what that true percentage is. So we found that a real uptrend when you were starting off, you had a lot of follow-through days in there. And that's going to be a critical buy signal that we're going to talk about. In almost every rally that is meaningful, you're going to see several additional follow-through days. So these all qualified, and that's going to become a buy signal that we'll talk about in a few minutes. All right, let's look at another one. This is in February of 2010 on page 8. So again, you're coming down, you're out of the market somewhere over here, and you're looking for a rally day. Here we get a rally day there. You immediately undercut. These are not pink day rally days because they were closing in the lower half. But then this would be a rally day right there. This would be your low, so that would be your line in the sand there, not the low of the actual blue day, but the lowest point that you hit. That's a critical thing to keep in mind. So this would be day 1, 2, 3. Then you undercut, so you start looking for another low. This is obviously not a pink day rally day because it closes at the low, but here, kind of a classic rally day, a shakeout below prior lows, closing at the upper half. That's ideal to see a rally day like that, but we've studied it, and many times you can have a good rally or a good bull market, and it doesn't look like this. But all things being equal, we'd prefer to see it start like this, where it's very clear, well-defined. You have a clear low at 2100, and it holds. So that's day 1, 2, 3, 4, 5. On your 5th day, you get 1.38. So then you start getting in the market. And this is the thing that turns on the buy switch that allows you to start buying stocks. And then again, we were marking all the ones for the first about 25, 30 days or so. And we saw that you have additional follow-through days. Let's look at another example. Okay, this is on page 10. So let's walk through this. So we're coming down. We'd be out of the market somewhere over here. We're looking for a rally day. We have one. It gets undercut. We're looking again. We have another one. It's undercut. We have a rally day. Then it gets undercut over here before you get a follow-through day. And then you have this classic pink day rally day. You know, I'd mark this as like a Bill rally day. This is a pink day rally day that he would really approve of. Huge spread closing near the eyes, and you've undercut significant lows. So that's something that he would really like. But if it just closed here, we would be fine with it. So that's day 1, 2, 3, 4, 5. In almost all cases, it doesn't really matter for your first follow-through day whether you said this was day 1 or this was day 1, because this would still be a follow-through day. We just count it as a 4th day instead of a 5th day. But it does become important with some of our other rules that we have. So this is day 1, that's day 5. It just squeaks by with a 1.25, and then we have several other ones in there that are a little bit more powerful. You can see they don't always lead to big, giant bull markets, but you can make a lot of money just in a few months here. In fact, at the firm, we made a ton of money just in this time frame. So you have to be able to get started, and then you have to have rules to get you out, and we'll go over those rules a little later. All right, so let's look at page 17. In your workbooks, we have all the major market bottoms marked up. So when you go home, you should really sit and study all of them. You learn how different markets behave, and a lot of times, the really severe bear markets end like this. We saw the last one here in 07. This is just a minor pullback. You can do a lot of damage to your account in that, but you have a kind of a capitulation bottom there. This is 2002, so this is after we were way up here in March of 2000. You come down to one of the worst bear markets of all time, And most people are saying we're waiting for a capitulation. If you have the TV on at that time, everyone's saying it's not going to hit a low until you have a huge capitulation bottom. And I thought that as well until Charles and I were studying, and we just happened to notice the worst bear markets tend to just end like this. They just stop going down, and you get a little rally day. So it was kind of interesting to see that the shorter ones have the capitulation in general, whereas the big ones doesn't look that bad because you don't see all the damage that happened. But how many people were trading from the 2000 to 2002 time frame? Okay. I think that's a real disadvantage for a lot of you that weren't trading during that time frame. There were a lot of learning lessons. I remember coming into the office and we would be getting killed, get in the market, we get out of the market, and Charles and I could get discouraged, and Bill was there saying, this is the best thing ever. You know, you're learning all the things not to do. And so he had a way of, you could never feel sorry for yourself. He'd say, I saw a lady pushing a cart in Santa Monica today and she's homeless, so don't complain if the follow through doesn't work. Did everyone trade through the 07 to 09 here? Okay, so you got a taste of that. That's lots of fun. So here, again, we're on page 17. We've had a severe bear market and we come down, we're looking for a follow through. So let's say we're looking for a rally over here. That's day 1, 2, 3, and we undercut this low. So we're looking again. So day 1, and then we undercut, so that doesn't work. Day 1, and again, we just undercut it a little bit, so this becomes day 1, 2, 3, 4. So that's your very powerful 4th day follow through, and then you have all these additional follow throughs on there. So this was a really big move off of the bottom, and that happened in the 30s as well. Any questions yet? Right here? Yeah, I'm going to talk about that this morning in just about 10 minutes or so. But we do put weight on it. That becomes a sell signal. Charles was talking about the art of it, and we'll talk about that at the end of the day. But look, when you move from this point to this point that quickly, and you've had a lot of really volatile times up here, it's very likely that you're going to be having a shakeout in here. In fact, I would have thought that it would have come into about here or so. But it's just one scary day, and then we would have reacted there, and then this would have been another buy signal. And by the end of the day, you'll see what our count would be and how invested we'd be. Yeah?
Mike, perhaps I missed fine for the pink rally, the blue rally closed within the range.
You didn't miss it. I didn't say anything about the blue, so thanks for bringing that up. A pink rally just has to close in the upper half, so 50% or higher on a down day. For an up day, it just has to be blue. We've studied it, and we didn't find that, it could be at the bottom of the bar. It looked very funny if that happened, and we did some research on that to see. But again, our point with all of our rules is we wanted to err on the side of getting into a rally because we have a lot of tools to get us out. Bill might look at it, and let's say it was a day like this right here. He might not count that as a rally day, but with our system, we would. We'd know how to exit the market if it didn't end up working. Any up day is day 1 for a rally day, and then any pink day that closes mid-range or higher, 50% or higher. Any other questions?
Is volume relevant on these days?
On the rally day, it's not. But on the follow-through day, it's critical that the volume is higher than the prior day, not above average. But the rally day, we looked at it, and we couldn't come up with anything that was significant enough to say we're not going to count it unless it's X.